Hello, I'm Steve Balch, the Director of Wealth Management and Financial Planning here at Certa Financial Planning, here to give you our market update for April. From a macro stance, the updates continue to be the same. The market trend continues to be positive, with March making it 5 straight months for the markets with a positive return. The Fed has held rates steady, keeping us in a neutral stance, but they did hint at 3 cuts coming this year, which would be a positive. The government continues to run large deficits, acting as a stimulus for the economy. This may not be positive for the long run, but for now, it's a positive for the economy and a positive for fiscal policy. Leading economic indicators continue to be positive. The job market continues to be strong, with February adding over 275,000 jobs, while wage growth continues to hover around 5%. Valuations we continue to stay neutral on, as the rest of the world offers attractive valuations. However, U.S. large cap PE ratios have moved up to 24.4 and is now 32% higher than the median PE of 18.5 times going back to 1988. Earnings continue to support the growth for now, but it's something to watch. Even with recent market volatility picking up in the recent days, we continue to be in a Goldilocks regime. One thing to note, we did add a graph to this slide with the risk on, risk off metric. The idea is to help better visualize what the market regime means for how we manage equity exposure. Currently, we are in a risk-on environment with Goldilocks. The U.S. business cycle continues to stay in the late stages, as growth is expected to be moderate this year. What are the 3 questions we're monitoring? What does a strong Q1 mean for the rest of the year? Will the Fed cut rates? Japan a leading indicator. 2024 has started strong, with the S&P 500 being up 10% year-to-date in March. There have been 11 previous times the markets have been up 10% year-to-date in March. The rest of the year, or the final 3 quarters of the year, were higher 10 of the 11 times. The one year that did not work was 1987. Historically speaking, the strong start to the year is a good thing and tends to mean more gains. Will the Fed cut rates? The Fed continued their rate pause in their March meeting and indicated that they still plan to cut 3 times this year. The market reacted positively to the news and moved the expected first rate cut to occur in the June meeting. However, the overall trend for inflation saw some heating up in March, as both consumer and wholesale prices came in a bit hotter. Additionally, February CPI reading of 3.2% is expected to rise to 3.4% in March, according to the Cleveland Fed forecast. With CPI reports continuing to come in hotter than expected, the market has slightly backed off its prediction of a June rate cut, and yields have started to rise. If a June cut falls off the table, the chances of any cut may start to diminish greatly in 2024. That is because the Fed does not want to be seen as political, and a first cut too close to the election may be seen as influencing. For now, a June cut seems likely, but we'll continue to watch as the probability of no cuts has increased with recent events. Japan a leading indicator. After nearly 4 years of negative rates, there are currently no countries with negative interest rates after the Bank of Japan raised rates above 0% last week. However, this may not be a reason for celebration. Over the last 4 decades, the Bank of Japan raising rates has been a leading indicator for predicting when the next global recession will start. This does not mean the indicator is going to be right again, but it is something to watch and see, as many global countries are seeing slowdowns or already in recessions. Our positioning outlook. Headwinds and headlines continue to grab the attention, but historically speaking, April is a bullish month and has done even better when stocks are up the previous 5 months. Incredibly, when stocks are up in November, December, January, February, and March, the previous 5 months we just had, the rest of the year, or the final 9 months, have been higher 11 for 11, with an average return of 11.9%. History can change and trends can be bucked, but for now, we continue to remain optimistic and continue to stay overweight on growth strategies and ride the positive market trend. We thank you for watching. As always, please feel free to forward this to anyone you believe can benefit from the information. If you have any questions, please feel free to reach out.